the accounting process. We've talked about doing normal entries. We've talked about daily business transactions, financial statements, a couple different types of trial balances. We've gone through the adjusting process. Now let's go through the closing process. So now we're at the end of our accounting cycle. This is the information from our adjusted trial balance. Don't have the heading here, but this is all of our other information contained within the adjusted trial balance. Remember, the difference between a unadjusted trial balance and the adjusted means we've gone through that adjusting process, made all those adjusting entries, and updated these accounts. Okay, so now after that, we've done our financial statements entirely, and now we're ready to close the books. That's what we're going to go through. There are 4 steps in closing, but before we get to those, let me talk about what types of accounts we're going to be looking at when we close. We're not going to close everything that we see here. The whole point of closing is to take those accounts that we want to keep totals in just for the year, or just for that specific accounting period. For us, it's our fiscal year. But some of those, we need to keep those balances, okay? What's one thing up here that you think, we might want to keep that balance when we start? So let's say our fiscal runs January 1 to December 31. On, December the 31st, our last day, now we switch over to January the 1st. Which of these numbers do you think we still want to see on January the 1st? You're probably going to want to see that cash still on January the 1st. You don't want it to go to 0, because when we do closing, we're going to take the account and make it 0 and start over the next accounting period. Well, we don't want to do that with things like cash or our building, or, we might want to do it with accounts payable or notes payable, but you can't do that. You still owe that money. So those things we're going to keep. Those are called permanent accounts. Permanent accounts are all of your balance sheet accounts. Those things you find on the face of your balance sheet are permanent accounts. We want to keep those balances. These other accounts are called temporary accounts. And these are the ones that we only want to keep up with for the year, and then we want to start fresh, start back at 0, and then start building again so we see what that activity is just for that accounting period, that year. So all of your revenues, all of your expenses, and your dividends account. Now remember, dividends is not a balance sheet account. What financial statement do we find it on? That one's on the retained earnings statement. Okay, and something to know about retained earnings also. This amount on your adjusted trial balance is your beginning retained earnings balance. If you went and looked at your balance sheet right now, it would not say $15,000 in retained earnings. That's because on the balance sheet it reflects all of the accounts that get closed to retained earnings eventually, or get put into it eventually. We've talked about that a little before. And remember, we said there are 3 things. Remember that tree that we talked about when I outlined assets, liabilities, and equities, and equity had several branches to it when we talked about it? Well, retained earnings had 3 branches, all right? Because revenues, expenses, and dividends all eventually get put into retained earnings. Closing is the way that we put them into that account. So the $15,000 here is the beginning balance in retained earnings, not the ending. It's not what you're going to see on the balance sheet, okay? We'll talk about that in just a second. So to close, let me type out over here your 4 steps to closing. All right? First step is to close all revenues to something called income summary. All right? This is a new account. We haven't seen income summary before, and you won't see it listed on this chart, on this trial balance. You won't see it in any report at all. Might not even see it on a chart of accounts, but you may. But income summary is a temporary account that's only used to close accounts, and then it disappears again. Okay, it shows up for closing and then goes away, because that's its only purpose. And the purpose of income summary is to have somewhere to close all of your income accounts to, your income statement accounts. So your revenues and your expenses get closed to income summary. All right, so 1 is to close all revenues to income summary. 2 is to close all expenses to that account called income summary. Once you've done that, all of your income statement accounts are in income summary. So the balance in the income summary account is your profit or loss for the year. So whatever's there should agree to your income statement now. The balance in income summary should now either be a credit if it's a net income, and it should be the same amount, or it should be a debit if you had a net loss, and it should also be the same amount that you see on your income statement. Okay? So once you've done that, the third step is to get rid of that account. Oops, sorry. We're going to close income summary to retained earnings. That's how those items get into retained earnings. We talked that the three branches, the revenues, expenses, and dividends, will get put into retained earnings. Well, this is how revenues and expenses get put there. They do not go directly to it. They go through income summary. But again, you're not going to see income summary on any report or financial statement or anywhere. It's just used for closing. And the fourth item is to now close, because we still got one of those branches left. We have to close dividends. But we close it directly to retained earnings. Okay, so these are the four steps of closing. Close all revenues to income summary, close all expenses to income summary, close income summary to retained earnings, close dividends to retained earnings. So when we close, again, the whole point is to make it zero. So how do you make a revenue account zero? Well, what's the normal balance in a revenue account? It's a credit. So if I want to make it zero, I need to do what to it? Debit it. So you're going to debit these revenue accounts. If I want to close all the expenses, to close, again, I'm trying to make it zero. What balance do expense accounts hold? Debit. So to close them, we're going to credit them. When we close income summary, it depends on the balance. You literally need to know what is the balance in income summary. So you take the first entry and the second entry and get a balance in the account, and then you do the opposite. If it has a credit balance, you debit it to close it. If it has a debit balance, you credit it to close it. And then dividends, what normal balance do they hold? Debit. So to close them, we would want to credit them. All right, let's walk through the actual entries for these numbers that you see over here. Okay, and I'll try to do some of these. We can do them right alongside for as long as I can have space for that. So first thing we needed to do is close all revenues to income summary. So let's look over here and find revenues. Well, I see service revenue and rent revenue. Those are the only two we see. So they are revenues, so they hold a credit balance. I want to make them zero, so I need to debit both of them. And don't write up here revenues and debit it. Revenues is not an account. We need to close each specific account to make it zero. So we've got service revenue, and we want to debit it for $50,000. And we've got rent revenue, and we want to debit it for $1,000. When we do that, those accounts will now be zero because service revenue has a credit balance of $50,000 right now, and rent revenue has a credit balance of $1,000 right now. We want them to be zero, so we debit them. And then we're going to close them to income summary. So that totals up to $51,000. So we credit income summary for that total. Step one's done. All right, step two, close all expenses. So again, let's go over here and look. Here are all your expense accounts. So we need to close all of those accounts, whether that's 1 or 50. We need to close them all. So let's go ahead and just list them. Or actually, let's talk about the expenses first. These hold a normal balance of a debit. So to close them, we need to credit them. For instance, salaries and wage expense, $24,000. Debit balance, I want to make it zero. How do I make that zero? I credit it for the $24,000. Now the balance is zero. So these are all going to be credit entries, and they get closed to income summary. So let's just list income summary first. And then let's go ahead and type in all of our expense accounts. It doesn't really matter the order that you list them in. This is not like a financial statement. Almost there. Oops. And I think depreciation got offline there. I put too many spaces in. Okay, so there's all our expense accounts. So let's come and put in our credit amounts because they're debit, so we're going to credit them all. So we had 24,000, 8,000, 3,000, $2,600, $200, and $300. Okay, we just add all those together to get the totals, and that total comes to $38,100. So that's the amount we're going to debit income summary by. That's step 2. We've closed all the revenues, we've closed all the expenses. Now it's time to close that income summary. I'm going to come over here and do step 3. So again, to figure out how much income summary has in it, we need to look at these 2 entries. We've credited it for $51,000. We've debited it for $38,100. Well, obviously your credits are larger than your debits, so we have more revenues than expenses. We had net income this year. And if you had your income statement, you could verify that. And obviously our net income is equal to $12,900, the difference between the $51,000 and the $38,100. So it has a credit balance, so I need to debit it to clear it out or to close it. So we're going to debit it for $12,900. And then we're going to credit retained earnings, because that's where we close income summary 2. That's step 3. Step 4 is to close dividends to retained earnings. So let's look over here. We've got dividends here, and it's $6,000, and that's a debit balance. To close that, I want to credit it, and I close those to retained earnings. So we're going to debit retained earnings for $6,000 and credit dividends for $6,000. Okay, that's step 4. Now we've closed all of the accounts. At this point in time, when you update for these 2 entries to retained earnings, the $12,900 and the $6,000, we've increased it for $12,900, we've decreased it for $6,000, and that makes sense. This was net income, this is dividends. Net income increases retained earnings, dividends decrease it. Now you'll see that when you update, the ending balance is $21,900. That's the same thing you're going to find on your retained earnings statement and your balance sheet. And what you'll do now is actually prepare one more trial balance. It's called the post-closing trial balance. And a post-closing trial balance is after you've posted all the closing accounts. So what's the last account you should see? Start up at cash. Yeah, I still see cash or $4,015. Keep on going down. What accounts should never be listed on a post-closing trial balance? Well, what did you just close? You closed all the revenues, all the expenses, and dividends. You're not going to see any of those because now they're in what account? Retained earnings. So you're going to see all of this detail, just like you do now. The last account you're going to see is retained earnings, but it will not be for $15,000. It will be updated to the new amount of $21,900. And again, we know that because the 15 is the beginning. We increased it here for $12,900 and we decreased it for $6,000. So this total will now equal what is on the retained earnings statement as well as the balance sheet.